it's not just GDP, it's not just inflation that we're trying to measure the rate of change within the sine curve. That really is our goal here in macro, is to identify not only where we are, but where we could potentially and probably be going given the context of where we came from. Okay, so when you get an expansion like US home prices, so again, HPI they call it, home price inflation. That was a mother of an acceleration. I don't know if you guys remember this, but coming out of 2012, Hedgeye went very bullish on housing, stayed bullish on, because again, we used home prices that are, ironically enough, but again, not surprisingly, are the best leading indicator for housing stocks. Because people chase price, it's called a Giffen good. So in other words, when the price is high, people buy higher. You know, that's called a Giffen good, which housing is clearly one of those Giffen goods. So we were really, you know, last year into the end of last year, Darius, correct me if I'm wrong, but you were at least plus double digits, you know, percentage growth.
Yeah, we're around 12%.
Plus, let's say it's plus 12 or 13%. Let's use 13% just because it's a higher number. Up 13%. That was the peak in rate of change terms of U.S. home prices. Currently, and so that's why it's so important to monitor. Where are we currently?
I think, I can't find it, but it's around 5%.
So it starts ticking down. This is when something goes from great to good. Tick, tick, tick. Again, 12.5, 12.2, 9.9. If you're at 5 or 6% right now, you might say, okay, this is where a lot of value guys get completely hammered because they're like, oh, but it's good, it's good. This is where Hedgeye makes their hay. When something goes from 13% to 6%, that's gone from great to good, and the next move is bad. Because again, housing, like anything cyclical, will eventually slow to the low single digits on home price inflation or home price appreciation, and that's when people really start to get nervous and mark down their home prices faster. The U.S. home housing market on the high end is one gigantic mark-to-model exercise. There are a ton of homes, and again, just to use one very wealthy corridor, which is basically between where I live in Fairfield and New York City, you know, Barry Sternlicht called it the most ridiculous housing market, or the ugliest one in Greenwich for that matter, in the world. You know, so again, that's because we're going from here to here to here. And that's a big problem, okay? That's why we're bearish on housing. And again, somebody might say, oh, but Keith, in Cleveland, homes are going up. I mean, seriously, man. I mean, look at slide 48, Josephine. 2/5 of U.S. consumer spending is in the top 20% of the population. That's not coming out of, unfortunately, all respect to the Browns, which, by the way, I like Terrell Pryor on my fantasy football team. All respect to everyone in Cleveland, but that's not where the top 20% of the population is, okay? 2/5 of U.S. consumer spending is in the top 20% of income earners. And moreover, the next slide, which is the most important point, the top 10% own 85% of the assets. So again, we've talked about this, but again, putting all this together to me, this at least is my career, this is my profession, this is what I like to do. I like to try to think about all these different things and get down to the deep simplicity of the point. And usually what it finds itself in is called the economic cycle. So that's how we do it. I think it's really important to be able to go from the British pound to China to oil to that housing picture. And again, to your question on taxes and tax revenues and what the property market could mean for future or prospective tax revenues versus this big fiscal plan, big fiscal spending plan that everybody wants to have. Allegedly, not me, but I mean, certainly the socialists want that. There's a lot to talk about. So let's keep talking.
So it's probably a good question, I guess. What's the best, you know, what gives you confidence, you know, when you're trading? Obviously, there's been a million reps over, you know, the last few years or last 10 years or so. What do you get confidence when you're at the top end or low end of a particular risk range versus saying, okay, maybe I waited another day or two to see how things shake out?
It's all the other macro factors.
Yeah.
So if I look at, so you know, we have this price, volume, volatility model. This is for equities. I just use VIX. It could be OVX if it's oil, whatever the volatility is in terms of how I imply it. So again, you got these three factors, but then over here, and really over here, you have the rest of the world's macro. I mean, it's constantly flushing, right? So I have 27 core macro factors that are constantly moving. And obviously one of those is huge, and some of them have, so when you look at the 27 macro factors that I focus on, first of all, they're changing, and sometimes some of them have heavier weights. So the number one weight, this is different than this. Over here, US dollar has been number one for a long time. Number two is 10-year yield, by the way. So again, this is number two. That's too many doodles. But if I can see just something that's happening in the marketplace that's going to drive the probable range of the dollar higher, for example, and I know that gold is highly correlated to the dollar, and I see that I'm registering lower, like I just hit the button again, it's 12.98 on gold. So it was 13.05 like 3 hours ago when I woke up. Okay, so I'm like, okay, that makes sense. I'll wait a little bit longer and just wait. Just wait for a couple more Fed guys to come out and go hawkish. And what would be great for getting an even lower gold price is if the ISM services number tomorrow is actually a good number or a hot number, because then we'll have even maybe we'll go to 170 on the 10-year bond yield. So again, when I think about trading around core positions, there's a lot that you have to be prepared for. I mean, that's what I do literally. I mean, the amount of work that I do on a weekend, I don't talk about because I guess people would say I'm being cocky about that too, but it's not cocky. It's what you have to do to be prepared. I mean, when I work on the weekends, I'm setting myself up like big time. I mean, I got my calendar, I got all my levels across my core 27 factors. I got where we are week over week contextually within the trends. Are they bullish or bearish? There's plenty of colors to get me prepared and ready when, again, something is calling to me to act. This is also the style factors where we are, themes. I mean, there's so many different things, Darius, that you have to. This isn't a game that you just wake up to in the day and robo-advise it. I mean, this is not what this is. I know people think they can do that, but it typically happens. People think they get a rules-based investing and robo-advisory or whatever the hell they want to call it. It's usually in a bull market.
Yeah.
Everything's easy when vol is low, volatility. When we start going like this, and then we start going like that, wow, robo this, it's going to be, you need a real human being. You do. I mean, there's not one person that would disagree with that in a down market that's actually run money across the last 17 years like I have. So again, this is what I do. I think there's a lot of components to it. I'd humbly submit that we're as good as anybody that's currently out there explaining what it is that they do, and I guess I'm the only one brave enough to kind of like put myself out there with my team. But again, there's a lot to this, and you do need a big team. It's humanly impossible to do this on your own.
We just got a process question. Can you explain the asset allocation model?
Sure. Let's see here. Maybe it's a good time to doodle.
Let's doodle.
How would you explain it?
I think you would know better than I would. Obviously, I would have you do it if you totally honest.
Yeah, so if you think of, so we call this the Hedgeye asset allocation model, i.e. KM's PA, personal account. Okay, so the way I think about my assets is really simple. I will take down my asset allocation to things when the price goes up, and I'll buy more of those things when the price goes down. I'm not a broker-dealer. I'm not a banker. I'm certainly not an advertiser, and I'm not a used car salesman. This is exactly what I'm doing in my personal account. So again, when you have different asset allocations, they can be US equities, that you can have international equities, you can have commodities, you can have FX, you can have fixed income, you can have Hedgeye stock. The reality, you probably can't have Hedgeye stock, but whatever, you know what I'm saying. Okay, 2, 3, 4, 5. So you have the buckets, right?
And cash.
Cash, don't forget, cash, I totally forgot. Cash is king. You got cash, one massive bucket of cash. We'll put that there. Cash. Cashish. Woo! Cash.
Bling, bling.
I love cash more than Shooter McGavin. Look, cash is where you put the money you made after you made it. Don't always put the cash to work. That is, for somebody who's been investing since I had money, which is in 1999 to 2000, I went from negative money or just loans, student loans, to I've gone through this with many of you, to having something that I could invest. When I make money, I prune and then replant when it's opportunistic. So in the Hedgeye asset allocation model, what you see happening every day, like for example, US equities, just went up for the last 4 days in the asset allocation. Because in my PA, I was buying REITs and utilities. So those are things I like, but they haven't been on sale for a long time. So I went from, what did I have, 2 or 4? I doubled my asset allocation to 8%. Now I'm not getting too picky here. You know, this is a net allocation as well. So it's 8%, but I'm also short the financials. And so I'm net long 8%. If I just wanted to be straight up neutral or 0% asset allocation, this year would have been easy because I would have been long the XLU and short the XLF financials. That's basically been our sector call in U.S. equities. I didn't really have to take any asset allocation exposure. I could have shorted the sector that I don't like against the sector I do like. Interestingly, maybe not surprisingly now, I'm more bullish on utilities, so I will take a net long position in U.S. equities. Similarly here, I got a massive net long position right now in gold. I mean, if you want to sell me your gold, by the way, give me a call, and I'm going to pay a discount for you because if you're a real seller, I'm going to get a good price. So you know, this is going up. That's a net position there, but I don't like oil, so it's not like a 25 to 33% position. The way I think about my cash and Keith's PA, and I've discussed this with my wife, is that I'm not going to put over 1/3 of our assets in any asset allocation. I'm not going to permanently market the TLT. I'm not going to permanently start a long-only mutual fund in equities. Again, 100% of your asset allocation or 60%, 60-40, that's ridiculous. It's completely and utterly ridiculous if you know what you're doing. And again, the idea is to compound your wealth. In other words, take your cash and build it when you have a high return so that on a rainy day you can invest it. That means there are many times where you could have 40, 50, 60% cash if you're doing it on your own. I understand that there, Billie Jean down the street and her grandma may not understand that. Great for them. They can go invest 60-40 and you can front run them all day long, okay? So if you're me, this is how I think about it. I'm constantly tilting U.S. equities, international equities, commodities, currencies, fixed income. FX came down most recently because the dollar went up, and that's the thing that I like. You know, I like dollars when they're down. I don't like them when they're up. So the dollar puts on like a nice big up move. I just take my cash position, or I take my FX position from a plus 4% net long position because I'm short euros. I take that down to 0. Booked it. Thank you. You know, again, this isn't my first rodeo. This is, I like to sell them high. I like to buy them back lower. The way you should use asset allocation, if you're a hedge fund guy and you're sophisticated to the point where you know how to short things, is to take a net position, net long when the things that you like are down, and then harvest those returns, sell them after the up move, put them in your cash bucket, and wait for the next down move. Comprende?
Makes sense.
Simple?
Yes. One other quick question, just to clarify, because we do get this. Do you ever go net short in any of the buckets, since it's a net allocation?
Well, that would confuse people. I do that, but I can't go that far, because then everybody's going, I can't short. Asset allocation, I'm just trying to think in absolutes, like where am I incrementally a buyer of assets versus being out of the way? That's what I'm trying to do. You know, there can and will be like a discussion with institutional clients, particularly long-short hedge funds that don't mind running net short, where I'd absolutely say at one point this year, are you kidding me? Utilities are up 20% this year. You're not going to sell them all. Get rid of them and just go naked short the financials.
I was on that call.
Yeah, I mean, it's not that. If you tell me, which is why we're regulated, we take Series 7, Series 63. I have to ask the client what they need. What is most suitable for them. If they're a short seller, yeah, you're damn right I'll go net short. But asset allocation for the people, the individuals, and again, we have a high net worth network of people that are watching this. This is the best I can do for now. But again, please give me more and more feedback. I'm not going to do what you want me to do. I will take feedback, and if it does make sense in terms of me iterating how I communicate what I do, I'll do that.
Awesome. Yeah, look, it's not perfect for everyone, but it definitely is transparent.
Yeah, it's 100% transparent, and imagine that. It's with my own money, and it's true.
Oh, yeah, absolutely. Jeff's asking, what could be the catalyst once all the dust settles and we start coming out of the recession?
Well, it's the damn cycle. That's always the catalyst. It's time and space. It does frustrate people when I tell them that, but again, it's uncomfortable before you have moments of entropy or surprise. But I'm not surprised. Are you really surprised? Were you surprised? Were you levered long stocks and short bonds going into the beginning of 2016 and surprised? Not if you were subscribing to this channel. So again, if wherever you go, you're still on that sine curve or that continuum of where are we? Again, I could show you for people that are new. Where are you on this curve for growth? You were here plus 3%. Now you're here 1%. What's next? 0 or 3? That's it. A lot of work goes into concluding that, by the way, but I'm simplifying it for you, and I do know that people want it simplified. So stop using things that are simply useless and get back to the program, which is central planners have not been able to slow this thing called economic gravity. You've slowed from here to here, which is a lot, and this last part of the move is usually the toughest one to manage, both on the up and the downside. Paul Tudor Jones, one of my favorite quotes. Again, the hardest part of the move to manage is the last part of the move. So, most people come in, they start buying value. Most people on the short side get out of the way. They're like, oh, it's all priced in, like the other question implied. But again, I'm not getting out of the way until this cycle has slowed to 0 and then negative. Don't forget for Q1 on a quarter-over-quarter SAR basis, GDP, we're at negative 0.8%.
What are your signals like concerning UUP and USD? What are the trend and tail lines?
Well, I'll be damned if we haven't had a bullish long-term dollar view with trading calls that have been bearish. Okay, so actually, let me explain that quickly. If you think about, just want to make sure we take the time to answer this question properly. So when we talk about, we've tried to explain, and I'll just reiterate, I think repetition's good. You guys see me all right? So we have multiple durations. We call trades, trends, and tails. Okay? 3 weeks or less, 3 months or more, 3 years or less. Where a lot of short-term traders get caught in a knot is that they have no idea on long-term investing or research. They don't even have a research process. They just look at charts. Trend, 3 months or more to 3 years or less. This is where this is where we built the firm. This is where I built my career, is getting those moves right. I can trade. I think people that watch me trade would say that I'm better than average. I'm not the world's greatest day trader. I hope you are, because if you are, then you have the world's best research firm in these two durations. So when it comes to the US dollar is bullish from a long-term tail perspective. It's plus or minus, depending on what the Fed's doing from a trend perspective. And same thing here, plus or minus, I should have written. So these things really toggle on where the Fed is going hawkish or dovish. So when we think the Fed's going to go dovish, for a trade, we're bearish on the dollar. And we've known, and again, that's why I'm a better than average trader, because I really get the dollar right a lot in terms of its directional moves, within the long-term context that the dollar and gold win the currency war. So again, winning the currency war means that since we are actually going to be the only country with a millennial generation and a demographic curve that looks much different than everybody else, actually the UK is going to have kind of a half-baked one as well. The rest of the world is just going to go off the demographic cliff. It's already going off the demographic cliff. So I think that what the pound looks like, the euro will eventually look like. The yuan obviously is being passive-aggressively devalued every day. The yen now is from a level that it could go down a lot. And we're just in this place where the dollar, it's really hard to get the dollar to go where a lot of people, including, how many people told you that, the dollar, because it's going to keep going down, is the next panacea for U.S. profits? If that were true, it would actually help corporate profits. But now the dollar's going up again because this long-term tail support has held. You'd have to break 92, 93 on the US dollar index for that to change.
What are some upcoming bond, bull, and gold catalysts in October besides the slowing jobs report?
I think it's just that we've hit levels. Again, the Chinese come back for gold. The level is the catalyst more so than anything else. Don't forget that people get whipped around because they typically don't do what I do. I'm talking consensus. If you're a momentum chart chaser, you're a CTA, you're a CMT, you're a ABC, upside down, yeah, you and me, whatever it is. You generally get freaked out by price momentum breaks on a short-term duration, right? I faded because I feed off moves in here. I don't know if you guys can see that. I think I'm pointing to. There you go. Oh, over here. When people are getting whipped around in here, I love feeding off this view. Okay? You'd have to get the 10-year bond yield above 2.04% for me to stop buying bonds, and you'd have to have, just in terms of a stop out, or reduce my position, not take it off, and my research view to change, which is highly data dependent, 30 data points per month in a predictive tracking algorithm, 90 data points flushed out quarterly. That's what's got me long bonds for 17 months, and I'm not going to change that. So again, when we think about this, the levels really do matter because the levels provide a capitulation in long-term bonds for these characters. This is where you're going to see the street.com go bearish on the street.com, a dollar stock, from the former dot bomb bubble. When they're telling you to short bonds, I assure you that my community of bond buyers, which include the Chinese and includes pension funds, includes municipalities, there's a huge bid for treasuries after they move lower. So again, I think the catalyst is usually time and space. Once you get to the low end of the range, the catalysts are mounting. It just incidentally for gold, in this case, the Chinese come back from Golden Week next week and they can start buying as well.